Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing variable versus fixed rates and why they are moving in opposite directions, with variable rates going down while fixed rates are going up. And it's a simple explanation. It all has to do with how variable rates and fixed rates are priced. And the big question is whether or not we're still recommending a variable rate mortgage. And I'll give you the answer to that at the end of this video. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their monthly rent or mortgage payment for a month just for subscribing to this channel. It's free and it's definitely worth it. All you have to do is hit that subscribe button. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's discuss variable versus fixed rates and why they are moving in opposite directions. And largely this has to do with how they are priced. Because for fixed rate mortgages, they're typically priced off of the comparable long-term bond market yields, and variable rate mortgages are typically priced off of short-term bond market or treasury bill yields, or off of deposit rates. So there's different mechanisms that are being used to price different types of mortgages. And what we're seeing in the market right now is that the mechanisms that are used to price variable rate mortgages are staying about the same, while the mechanisms that are used to price fixed rate mortgages are going up. And for the most part, people understand that variable rate mortgages are priced off of prime, and that is true, and prime is determined by the Bank of Canada's key lending rate. However, but what they typically don't realize is that there's another component to the pricing of variable rate mortgages, and that is how the discounts are priced. And how the discounts are priced is off of short-term interest rates. So things like deposits or mortgage-backed securities or short-term treasury bills. And if you go ahead and we take a look up here at our short-term interest rates, what you'll see is the treasury bills for 1 month or 3 month or 6 months or a year haven't gone up much in the last couple of days. Now, if you contrast that with the long-term bond market yields, you can see that there was a major spike here around the end of February, where interest rates increased quite substantially. So we'll take a look here. What you can see is that, basically 10 days ago, you could get a 5-year government bond yield of 6.64%, and now it is up around 0.93%. Actually, it's coming back down a little bit today, but for the most part, long-term bond market yields are going up. And the reason for that is because there is an expectation that the US economy is going to get better. It is going to have a little bit more inflation going on, and as a result, we're seeing big retail investors move their funds out of the bond market. When they move their funds out of the bond market, that means that the prices of bonds go down, and therefore the yields go up. And when the yields go up, what that means is that fixed mortgage rates increase in price. Because when you take a look at a 5-year fixed mortgage, it is priced off of a 5-year bond. And if the price or the yield of the 5-year bond has gone up, well, that affects the cost of funds for that 5-year mortgage, and therefore you see the 5-year fixed rate go up. Now, contrasting that again to variable rates, we basically are seeing the short-term market be pretty much flat. And the reason why the short-term rates are pretty much flat is because there's still the expectation that rates are going to remain the same, at least from a central bank perspective, for at least the next 3 to 6 months to a year. Now, what's happening in the longer-term bond market is there's an expectation that there will be inflation and that there will be a faster moving market and a faster moving economy in the next 3, 5, 7 to 10 years. But that same expectation isn't true for short-term interest rates. So that's why we're seeing the variable rates, which are priced off of the short-term bond market or the short-term treasury market, we're seeing them stay pretty much the same, in fact get a little bit better, while we're seeing the long-term bond market increase in yields, and therefore we're seeing 5-year, 7-year, 10-year fixed rates increase. Now, what does that mean for borrowers? Well, if you are in the market for a mortgage right now, what it means is that you're going to pay substantially less for a variable rate than you will for a fixed rate. So let's say you're getting a $500,000 mortgage and the 5-year fixed is priced at 1.94%, and you can get a 5-year variable at 1.45%. Well, there's about a 0.5% difference in those prices. And at $500,000 in mortgage amount, that means about $2,500 a year difference in those two prices. So if we assume that what Tiff Macklem and the Bank of Canada is saying is true, which is we're going to have low interest rates for at least the next 2 years, then what that means is that on a $500,000 mortgage, it's about $5,000 cheaper to get a variable rate than it is a fixed rate. So what that leads us to is a question of whether a bird in the hand is better than two in the bush. So if you are taking a variable rate mortgage and interest rates stay the same for the next 2 years, and the short-term bond market yields or treasury bill yields are telling us that it should stay the same for at least 12 months, and the expectation is that it will be 2 years, because for the TIF Meklem and the Bank of Canada to increase interest rates prior to the US doing so would pretty much lead to an increase in our dollar value, which would mean our goods would get more expensive, and Canada is a net exporting country, which means our economy would suffer with a greater dollar. So you can pretty much rest assured that the Bank of Canada isn't going to make any moves until the Federal Reserve does. So is that $5,000 in savings for the next 2 years worth locking in, or do we want to take a 5-year fixed rate in the expectation that interest rates will go up so much that taking a 5-year fix today will exceed the savings that we would have by taking the variable rate mortgage? And the answer to that question is it's highly unlikely now, with the spread being so big between variable and fixed rates, that taking a fixed rate would be a good strategy, because in the long run, if we know we're going to get 2 years where we're going to save $5,000, then what we need is not only for interest rates and prime rate specifically to come up by 0.5%, but we need it to come up by significantly more than 0.5%, maybe 1%, maybe 1.25%, before we're in a break-even scenario. And then it would need to come up even more than that for us to be worse off. So the math on a variable rate mortgage still works. It still makes more sense to have a variable rate mortgage. And for me, the big thing, and what I'm most concerned about, is I'm concerned about penalty exposure. Because the number one thing that costs people money on a fixed rate mortgage is not only the premium that you pay to get a fixed rate mortgage, but the premium you pay to get out of a fixed rate mortgage. So that is my primary concern. And with 60 to 70% of people breaking their mortgage in the first 5 years, we want to be able to make sure that people can get out of their mortgage if they want to make a move. Because here's the thing, yes, the market's crazy right now, housing prices are going up, but there's a really good chance that we're nearing the top of a market and we're going to see pretty much flat housing prices for the next 3 or 4 years, because they can't really go up a ton more than they've gone up as of late. And what that means is that if people want to make moves in the next few years, if housing prices remain flat, the problem is with certainty going to be that if they have a penalty, that's going to eat into their equity. So our primary concern is making sure that, one, people have a good strategy that saves them money, but two, that they aren't going to end up in a scenario with a 5-year fixed mortgage where they're going to have a big chunk of their equity taken away from them because they had a fixed rate product. Now, the other thing we can consider is if somebody wants to take a variable rate for the next 1 to 2 years, lock in those savings, and then lock into a fixed rate down the road, that may be a good strategy depending on what happens in the economy. But for the most part, variable rates is still, with certainty, the way that we want to go, especially with them getting significantly cheaper now in comparison to their 5-year fixed counterparts. So if you found this video useful, if you found this information exciting and entertaining, well, it's mortgage stuff, so it probably wasn't exciting, but if you found it useful, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about a race to 10,000 subscribers, where one lucky winner is going to win their monthly rent or mortgage payment. We'll see you on the next video. Hope you have a good one. Cheers.